Hello and welcome to a brand new episode of Smart Money. Now, there's one category of funds that is bridging the gap between active and passive funds. It's called Smart Beta funds and is gaining traction now. A Smart Beta index fund operates as a passive investment vehicle tracking an index that selects stocks using a specific strategy. In essence, these indices draw stocks from broader indices like the Nifty 50, Nifty 100, Nifty 200, employing criteria like low volatility, quality metrics, momentum and dividend yield. But why are we talking about this? It's because there's a lot of traction that's now picking up in some of these categories. To talk about how you can use Smart Beta funds in your investment journey, we have with us Swarup Mohanty, the Vice Chairman and CEO of Mirae Asset Investment Managers. Swarup, always a pleasure having you here with us on CNBC TV18.
Sonia, thank you so much for having me on your show. It's doing so well. It's a pleasure being on your show today.
Thank you. I mean, we just want to educate our viewers about several topics, and I'm glad we picked this because it's a fairly recent, addition to the entire mutual fund space. Just for people who have no idea about it, can you explain to us what is the concept of Smart Beta investing? How does it bridge the gap between passive and active investment strategies?
See, I think when you look at the globe in late 60s, it was all about inefficiency in the market. So alpha generating was fairly possible. So the 60s was all about active investing. Towards the end of the 80s or 90s, then people realized that in this pursuit of trying to get returns above the market, the risk of underperforming the market was also large. Hence, that gave birth to the upswing in passive investing, which is like buying the market. And then towards the late 2000 or the beginning of the 2000s, then came the fact that why don't we get in some of these active strategies into the passive side and form some rules around it. Like you mentioned, on volatility, on momentum, on quality, and hence form a very sustainable rule-based approach to investing over the passive indexes. Suppose there is Nifty 50, which broadly showcases the market, and I add a certain rule above Nifty 50 and say, okay, let me give you the alpha stocks which I think are in Nifty 50, or say 30 stocks among now the top 100, which I think can be far higher alpha generator than the broad 100 stocks. So you can then form a rule on it, and that gave birth to what we call Smart Beta, or what we call factor investing.
But that again then defies the purpose of investing into passive funds, right? Because see, in an active fund, what you have is this fund manager bias as well. There are several other things that go into an active fund. The reason I'm moving to a passive fund is because I just want to purely benchmark the index. Then how does Smart Beta come into play?
There are two types of investors. I mean, the first investor, like I rightly said, realizes that in this process of trying to beat the market is the possibility of underperforming the market, and does not want to take that underperformance risk. So hence he or she picks the passive fund, which is the broad market cap indices. But there are those people who say, okay, fine, the fund manager comes with some subjectivity. I would like to move to a rule-based category, and that's where the brilliance of Smart Beta comes in. Because what will happen is, when it comes to the same kind of connotation between active and Smart Beta, say the same fund manager might be looking at quality, but there comes that, like you rightly said, subjectivity. Might apply it, might not apply it, but in a factor, it will apply. So once you read up what a factor does, and then the essence or the brilliance of rule-based investing over a period of time has its own merits, and that's how factor investing over a period of time is gaining fair amount of traction globally. We are seeing the birth of it in India. As it starts building its own track record, you will see that people will probably choose this as one of their choices in their investing portfolios.
So currently, are there any Smart Beta funds? And if yes, what is the size in the Indian market currently? And how do Smart Beta indices compare to active funds in terms of the stock and sector exposure?
See, I think broadly both mimic the same kind of approach. Active investing and Smart Beta investing are practically the same approach. The only difference between being that the active investing comes with its subjectivity of the fund manager, which may or may not apply. It depends on the fund manager's choice. But when it comes to Smart Beta, for the sake of repetition, it is rule-based, hence it will always apply. Just to give you an example, suppose we are talking about, say, now it's better to talk about small caps because that's what is in everybody's mind. Now, the big factor that comes in is, say, the liquidity of small cap stocks. That's also been in vogue in discussions like that. Here, it will apply a liquidity filter and thrash out all the liquidity. What happens is, first there is an elimination of stocks as a process. And when you apply the factor, then the selection of stocks, then the weightages. Suppose I say, in that I will only take 3% weight per stock. and hence the weightages are applied, and then the portfolio happens. It's a laid out process which is bound to happen. So, though essence of both the approaches are the same, but the probability of taking those stocks definitely is more in the smart beta side than in the active side.
Are you also talking about, I was also asking you about how many such funds there are in the market currently, right? And how big is the size, the opportunity size according to you?
It's just the beginning. I think we're around 18,000 crores as we speak, but growing by the day. Like I said, as the track record starts building, people will realize the power of a rule-based investing. And we see this space growing because fact is, Indian investors are still yet to get out of the alpha generation phase. So I do suspect that since, and to be fair to us, we've watched this story unfold globally. So we are able to pick and choose some of the good factors that are there globally, apply them, or I think, jump to that rather than go through the rigors that the global markets have gone through. Correct. So I think growth of smart beta will be quicker than that of the globe is my suspicion. As we speak, I think around 18,000 crores of assets roughly under management, but I won't be surprised it starts doubling very quickly.
It's still quite small that way.
Yes.
Less than 20,000 crores in smart beta investing. Okay, you were telling us about some of the similarities and differences between active fund managers and smart beta strategies, right? In terms of investment styles, investment performance across market cycles, any more that, differences that you want to add?
I think both will be cyclical. I think when you look at both the styles, suppose earlier in our simplified active management days, we used to have growth and value. So there were long cycles when value wouldn't perform and growth guys would hit the NAVs higher than say the value guys. But as we speak, suddenly there has been a turn in the last 2 years. The erstwhile value looks like growth and the growth guys look like value. So similarly, when you apply factors, they are also cyclical in nature. Sometimes, say in bearish markets, we've seen value doing well. Say in bullish markets like that, you will see momentum doing well. In long stretches of bearishness, you will see quality doing better. So it depends on what factor you apply, and I would really request all investors to read all those factors before investing, and hence they will get a more clarified, approach to what they can pick and choose. Okay. Sometimes it's a combination of many factors also, like, you can put liquidity, you can put quality together and combine it to make a better sort of outcome.
So Swarup, for someone who's in this age group of say 25 to 40, right, 25 to 35, what should the best allocation be, strategy be between active funds, passive funds and smart beta funds? What's the best way to approach it?
See, finally there is no difference in the approach. The approach, I still maintain that the approach has to be goal based. Based on your goal forms your portfolio. And now an active investing and a factor practically are the same approach. If you take out the subjectivity of the fund manager or the skill of this fund manager or the expertise of the fund manager and replace it by a rule, that's where is the difference. Otherwise, I don't see any I don't see any change in the approach to selecting what should be better. Depends on the individual. I think I would really at this moment look at factor investing through large distributors of advisors, because it's the starting point in selecting which are the right factors which will cater to the risk profile of the investor. But the formation of the portfolio, the values or the rules that go into formation of the portfolios remain the same of active versus factor investing.
Okay. Can you explain the concept of active share and how that applies to smart beta products?
See, I think when you look at active share, if you're looking at say Nifty 50, right? How much of that 50 is in that stock is what would form the. You'll be surprised to know that in factors, the active shares tend to be higher than a lot of active fund management, and that's how factor investing has become popular globally, because the active share of the underlying sometimes become far higher than what happens. Or suppose when you look at say momentum as a factor, so the number of momentum stocks, because it is role based, will always be higher than say anybody who's put it in a subjective manner, is my simple point.
Okay. And what about portfolio churn? How does that happen in smart beta indices and compared to that of active funds? Because, I believe that this fund manager bias is something that it's real, right? I mean, For example, I've been investing in this market for over 15 years, and there are so many funds where I started investing based on one fund manager's expertise. Over the years, that fund manager has left and gone, and I was left wondering, what do I do next? So as time passes, I'm sure this whole fund manager issue will be resolved. There's so much AI now, there's so much quant investing as well. So what factors should investors consider when they choose, these smart beta funds?
So the great John Bogle has said that the index is perpetual, right? And that's the beauty about making it rule-based, that the rule is perpetual, right? But at the end of the day, if you look at it from an Indian market perspective, you still can't take away the expertise of brilliant fund managers in the market. So at this moment, the investor is spoiled for choice. He or she can choose great fund managers with great track record already in the market.
No, that's not my question. My question is, of course, fund managers are great, but everyone has a life cycle, right?
That's what I was coming to.
Leave.
Yeah. So, but at one point of time, these changes do happen, and that history of change is there in front of you. Now, if you believe the way to go ahead is active, please choose it. But the simpler way is to apply the factor. The rule will always be persistent, and the rule will play out. So, to answer your question on churn, typically the churn of factors and active is very similar. I would suspect the churn of factors can be higher because it will definitely apply the rule on the rebalancing day. But for the investor, the churn has no meaning because when you take away the cost of active management, most of the factor funds will come at a far cheaper price than the active fund management.
Okay. Can you provide some examples of, how smart beta indices have performed historically in several markets? Because it's still a nascent concept here. So, historically, how have the returns been?
See, my best example is always the Alpha 30. If you look at the Alpha Nifty 200 Alpha 30, the Alpha 30 has outperformed all practical funds in those respective comparisons on any horizon. You can check that out because, again, bringing out the merit of the rule-based investing over a period of time. It does go through its cycles, ups and downs, but when you spread it over a period of time, the Alpha 30 has distinctly outperformed most of the market.
Okay, we'll talk more about that in a bit. We'll also take a short commercial break. Don't go anywhere. We'll come back with Swarup Mohanty to talk more about smart beta investing and, of course, what his view is on the overall market. Stay tuned. Welcome back. Still with us, Swarup Mohanty of Mirae Asset Investment Managers, talking about smart beta investing and how you should approach it. It's still a very nascent concept in India, but it is expected to pick up quite a bit considering the global appeal as well. Swarup, how has the alpha factor distinguished itself as a performer among smart beta indices?
See, actually, the alpha factor plays out to the rule of distinctly moving between large and mid caps.
And first, tell us what is the alpha factor for people who don't know.
Yeah, I mean, the alpha, as the word says, aspires to give you returns above the market. And that's where the name Alpha 30, say for our case, it's an Alpha 30. We pick up the 30 stocks which we feel will be the formation of the portfolio, which will outperform the market. This, the factor moves dynamically between large and mid caps, and as per the market cycles, tends to pick them up as per the rule, underlying rule. When you see that over a period of time and you see the underlying cyclical nature of the market, it tends to then catch those 30 stocks which then tend to outperform. Till now, it's done quite well. Time will test in the going forward because the more the volatility is in the market, these factors are more tested. And when you look at, say, COVID as an example, some of these were tested very, very rigorously. And on the comeback, they did come back. But in this short period of time that it has been there, over the last 2-3 years, it's done fairly well. And the dynamism of its ability to move and ruthlessness at which the rule comes in and drops stocks and picks up new ones is what really makes these strategies very powerful.
Do we use a lot of, does the industry use a lot of generative AI tools as well now to sort of pick stocks, use filters, the criteria, etc.?
I think a lot of algos have started being used now. Algo is very different from AI. AI sits on an algo and tries to learn or teach the algo. I think we are yet to start. We just recruited our head of AI last month, so we will probably in the next 1 or 2 years try to build our own AI generative sort of support to fund management. Hopefully someday we might see the first AI generated fund in market. Please differentiate between AI and algo. They are two very different things. Factors are kind of an algo. It's a rule-based thing. But AI, when it comes in, tries to learn from that and generates far higher information than what an algo does.
Okay, so and what role does the dynamic shift between large cap and mid cap segments play in the performance of smart beta indices?
See, I think it's the same as what a fund manager aspires to do on the active side, picks up the stocks that they think will do better in the future. But here the only difference, like I've been harping time and again, the rule does it. So on the day of rebalance, it will definitely pick up the stocks which cater to the alpha factor and drop the stocks which will go out of the alpha factor. Unlike, say, it is possible that the fund manager might not take it on that day or might take it that day. There is no subjectivity. But this dynamism to move between large and mid, thankfully the markets have been cyclical enough to give those opportunities to the factor to play out, and that's why this outperformance has happened.
Okay. And how do rolling return performance of smart beta indices provide insights into what the long-term performance can be? I mean, on an average, what are we looking at in terms of a long-term performance for smart beta indices?
See, I think the rolling returns bring out the consistency of any return, and it's true to any fund as we speak. But as the factor then plays out, or any factor plays out over a period of time, the rolling returns is always a superior way of analyzing the consistency of that strategy. For that matter, any strategy. Of course, if the outperformance has been there, rolling returns will be superior, especially for 2-3 strategies we are seeing to play. For that matter, if you look at the low vol, I think the low vol across the market has also played out very well on rolling returns. So we are beginning to see some of these strategies play out, but I suspect once they start becoming strategies of 10 years, 15 years, you will see the real power of rolling returns coming out in them too.
Okay, so can we discuss the practical application of smart beta strategies now? How can investors use it effectively in their portfolios? Because as we were saying earlier, right, it's a very nascent concept. It hasn't really picked up steam. Why do you think it hasn't picked up steam yet? And what is your advice to investors who are watching you right now?
See, broadly, if you look at Indian mutual fund data has enough biases in picking up funds. People typically, and industry data will tell you, people buy last 1 year return and redeem last 1 year underperformance. It's beginning, the birth of financial planning or portfolio formation based on goals is just about starting off. And once we see merit, more and more merit into that, I suspect a lot of young will get into that sooner than, say, people like us did, because we understood goals quite late in our life. We will see advent of such products forming pretty decent part of people's portfolios. Now, again, formation of the portfolio is very centric to the person's goal. Now, I am not a fan of saying that the alpha or the factors are high risk or low risk. It depends on the risk profile of the individual and the understanding of the underlying investment which they want to make. Good factors can play a great part in the core portfolio also. And one can obviously use some of the risky factors to form satellite part to get that kicker in that portfolio for that additional return. So they play both parts, as well as the core, as well as the satellite. But one can today form a proper portfolio with factors only. I mean, with a mix of good active, passive and factors, one can form a very strong portfolio to withstand some of the volatilities of the market.
Okay. And by satellite, you mean over and above your regular portfolio, right? Just for those who don't understand what satellite portfolio means.
I mean, when you look at the core portfolio, you talk to any fund manager, the fund manager will tell you buy a good company at a good price.
Yes.
The good, strong, large companies form the core portfolio, which gives you, attempts to give you a more stable return than the fluctuating return. That is invariably the larger, stronger companies in the market. The satellite portfolio then comes in to catch some of the high risk or trends in the market to give you that kicker in the portfolio. Correct. Some of these factors say...
A little bit like gambling, if you want to say.
No, it is calculative. I won't say gambling, but if you have a view. Like today's market, the market has moved in a certain manner. The rest of the market is open for you to buy. And if you feel at this point of time some great companies are available at some great prices, then you can buy them slightly higher than your allocation so that, longer term return on the rebound of those stocks can be higher.
Okay, absolutely. Finally, because the market is a bit volatile, right? Before we let you go, before we end the show, what's your view on what's happening right now? Because it is a tricky spot. There is a bit of a corrective phase. No one knows how long the corrective phase would last. Are you worried about a major protracted correction, or do you think this is just par for the course?
Sonia, again, there are two people in the market. There is a buyer, there is a seller. A buyer would want the market to go down, the seller would want the market to go up. I'm a buyer in a story called India. The more the market goes down, my SIPs get more units, I get more value for my buck. So when you look at this story, and I always end all my presentations with one slide now, do you look at Sensex at 70,000 or do you look at India at 7 trillion? It's how you view it will define your approach, right? It is going to become a 7 trillion economy. When you look at that, these kind of corrections are great times to buy stocks which you've probably missed in the past, or buy strategies which you've missed in the past and strengthen your portfolio. I've said in 2017, 18, 19, redeem India at your own risk. I say that even now. This is probably the only country in the world growing at 6-7%. You don't get those stories at these prices because of these corrections. Yes, the geopolitical nature in the world has made data fragile. If you see sudden U-turn in the interest rate projections, it's taken all of us by surprise.
Correct.
And that's the beauty of the market. Once you think you know the market, it will surprise you.
But geopolitical events have always been a great buying opportunity also in
Yes,
the past, right? So that could continue. One thing that's also working in India's favor is the demographic dividend, right? Everyone's talking about that. How long do you think it will take before we reach a mature stage in the demographic dividend? I'm asking from a stock market point of view. And also the other thing to supplement it is job creation, which is now a bit of an issue, right? Do you think it could be a lost decade because of the lack of proper jobs that are created in the market to capitalize on this demographic dividend?
So yeah, like you rightly said, if 60% of world population under 30 are in this country, the demographic dividend is there for all of us. But at the same time, it has to be supplemented by job creation and, more important, the health of people. If these two are not created, then after a decade, we'll see those playing out. I'm sure the powers to be will address it, but those are true concerns coming out of India. But nothing can take away this decade from India. I mean, the present situation will take it past the decade. And if these are not addressed, then maybe in the 11th or 12th year is when we should talk about the impact on this. But according to me, and this something which we've echoed time and again, it's the time to buy India at this moment, and every correction is welcome, if you ask me.
Okay, and I mean, we haven't even got a correction yet, right? It's sort of a corrective phase, but you're saying if it continues, then always go ahead and buy. Perennial bull, I think, Swarup Mohanty, right?
No, I'm a buyer, yes.
You're a buyer, okay. Thanks a lot for joining us. It was a pleasure speaking to you and trying to understand and educate our viewers about, several concepts. Hope to have you again on the show.
Thank you so much, Sonia. Thank you so much for having me.
All right, with that, it is curtains down on another edition of Smart Money. Thanks a lot for watching. Keep writing to us. We love receiving feedback from you. Until we meet again, have a great weekend.